Hey everyone, and welcome. Have you ever been looking at the top of the stock market and just noticed something kinda weird? You see a company so massive, it actually seems to take up 2 spots in the top 10. Well, today, we are solving that exact puzzle. Alphabet's dual identity as GOOG and Google.
Right? It's a fantastic question. I mean, you look at the most powerful companies on the planet, and it's one name, one ticker. But then you get to Alphabet, and it's listed twice. Now, this isn't a glitch in the matrix or some kind of mistake. It's actually a very deliberate and pretty brilliant piece of corporate strategy. Let's dig in and find out why.
Okay, so to really get our heads around this puzzle, we first have to understand the playground where all these giants compete, and that is, of course, the S&P 500. Just as a quick refresher, it's basically the list of the 500 biggest public companies in the US, and it's a huge benchmark for how the whole market is doing. This is where the biggest of the big live.
Now, take a look at this list. The first thing that jumps out is just how much tech dominates everything. You've got Nvidia, Apple, Microsoft, all at the top. But then look really closely. Right there at ranks 5 and 6. There it is. Alphabet Inc., Class A, ticker Google, and right below it, Alphabet Inc., Class C, ticker GOO. 2 separate lines for the exact same company.
And here's the real kicker. If you take those 2 separate weights and you add them together, you get 5.73%. You know what that means? That combined weight would actually launch Alphabet into the number 3 spot, leapfrogging even Microsoft. So this isn't just a fun little quirk. We're talking about a massive, massive force in the market. So the big takeaway from all this is just the incredible concentration of power at the very top. I mean, just these 10 names drive almost 40% of the entire index's value. And the theme is obvious, right? It's all about AI and the cloud. This intense focus is exactly why understanding the Alphabet anomaly is so important. Okay, now for the main event. Let's get to the heart of the mystery. Why on earth would a company create 2 different tickers in the first place? Well, it all boils down to one simple, yet incredibly powerful idea: having a vote. And boom, here it is, plain and simple. This is the fundamental difference. If you own Google, which are the Class A shares, you get 1 vote for every share you own in big company decisions. You get a tiny, tiny say in how things are run. But if you own GOOG, the Class C shares, you get the same economic piece of the pie, but 0 voting rights. Zilch, nada. So why do this? It's a clever strategy that's all about something called founder control. It's basically a way for the original creators of a company to issue a bunch of new stock, maybe for paying employees or buying other companies, without ever having to worry about losing control of their vision for the company.
In fact, it gets even more interesting because there are actually 3 classes of shares. You've got Class A, the Google L ticker, for public investors like us. That's our 1 vote. Then there's Class C, the GOOG ticker, with no votes. But the real power, that's in the secret Class B shares. You and I can't buy these. They're held by the founders, and each one carries a massive 10 votes, making sure they always have the final word.
Okay, so we get it. One has power, one doesn't. But the real question for us as investors is, does this power struggle actually make a difference to our wallets? Let's talk about the price.
You know, this is what you'll hear from traders all the time. Despite the whole voting rights difference, the 2 stock prices move in almost perfect lockstep with each other. And it makes sense, right? At the end of the day, they both represent the exact same business.
And you don't have to take my word for it. The data says it all. Just look at this snapshot here. The price difference, or the spread between them, is usually just pennies, maybe a dime, on a stock that's worth hundreds of dollars. And you can see, sometimes one is slightly higher, sometimes the other is. The difference is just tiny. So the classic theory, the old way of thinking, was that Google, the shares with the vote, should always trade for a little bit more. And that seems logical, right? A share that comes with a vote should have a voting premium. But here's where things get kind of weird. More recently, we've seen something called a liquidity flip. That's where the non-voting Google shares can actually trade for a tiny bit more. And this probably happens because big institutions and index funds often prefer to trade the Class C shares, which drives up the volume and sometimes the price. So, what stops these 2 from just drifting way far apart from each other? Well, the answer is this powerful market force called arbitrage. The instant any real price gap opens up, a bunch of super fast trading computers pounce. They buy the cheaper one and sell the more expensive one at the exact same time, and that action closes the gap almost instantly. They're basically glued together.
All right, so all of this brings us to the final and most important question. Which one should you actually buy? Let's take everything we've learned and boil it down into a clear, practical takeaway for you. So for a lot of us, and I'm including myself here, especially for anyone who likes to use strategies like selling covered calls, the whole voting thing isn't really the main event. It honestly boils down to two very practical things: options liquidity and, of course, dividends.
And here's the answer that a lot of traders land on. Class C, the GOOG ticker, often has a little bit more trading volume in its options contracts. Now, for an option seller, more volume usually means a tighter bid-ask spread, which translates into getting a slightly better price when you sell your contracts. It's a small edge for sure, but over time, those little edges can really add up.
And what about the dividends? Is there an advantage there? Nope, it's a total wash. Alphabet pays the exact same dividend to both classes of shares. As you can see, there is absolutely no reason to pick one over the other if you're investing for the dividend yield.
And so that really leaves us with this final thought. The choice between Google and Google is almost a philosophical one. For the founders, it was all about control. For most of us as investors, it's just about putting our capital to work. So when you look at these two tickers, you have to ask yourself, are you here for control or are you here for capital? For most of us, I think the answer makes the choice pretty clear.